Governments fall. Presidents change. Elections shock the world. Yet the financial system almost never does. Every crisis feels political. But the decisions that shape your wages, your savings, your future, are rarely made in parliaments. And almost never at the ballot box. Interest rates rise. Money appears. Debt survives collapse. And it happens quietly. Through institutions you don't vote for. And leaders you'll never see. This is not a story about secret meetings or hidden villains. It's about how financial power learned to outlive political power. Because when money governs nations, the real question isn't who runs the government. It's this: who governs money? For most of human history, power was visible. It wore crowns. It sat on thrones. It signed decrees with wax and seal. If a nation went to war, you knew who paid the cost. Taxes were raised. Gold was demanded. Debt was borrowed openly and painfully. Money was limited, and so was ambition. Before the modern era, financial power lived inside the state. Kings controlled treasuries. Parliaments approved spending. Banks existed, but they served governments, not the other way around. The system was imperfect, often brutal, but it was transparent. Gold and silver anchored currencies. Coins had weight. Paper money promised redemption. If a ruler spent too much, the consequences arrived quickly. Inflation, unrest, collapse. There was no hiding from arithmetic. Wars revealed this truth more than anything else. Armies drained treasuries. Navies devoured gold. Empires expanded until the money ran out. The Bank of England, founded in 1694, was revolutionary, but still subordinate. It financed the crown. It did not replace it. Even during the gold standard era, limits were clear. Governments could not simply create money at will. Political promises were constrained by the metal in a vault. When crises came, they were immediate and visible. Banks failed publicly. Currencies broke openly. The public knew who was responsible. But as empires grew larger, the old system began to strain. Wars became global. Supply chains stretched across continents. Military technology became exponentially more expensive. Gold, once a foundation, became a cage. Governments faced a dilemma. They needed more power, more flexibility, more capacity to spend. But the monetary system refused to cooperate. Taxes triggered revolt. Borrowing triggered panic. Gold limits triggered collapse. The public could see everything, and they reacted. So leaders began searching for a different solution. Not a louder form of power, a quieter one. One that could finance ambition without immediate backlash. One that could survive elections, revolutions, and regime change. One that could operate beyond the rhythm of politics. This wasn't a conspiracy. It was a structural necessity. The old model, where money answered directly to politics, was breaking under the weight of modern complexity. Slowly, almost imperceptibly, a new system began to emerge. A system where financial decisions would no longer look like power, where they would be called technical, neutral, independent. A system that wouldn't rule nations, but would quietly outlive them. Because once governments realized that visible power had limits, they began building something far more durable. Power doesn't disappear when it becomes controversial. It changes shape. By the early 20th century, governments across the world faced a shared problem. Modern states had become too large, too complex, and too expensive to run under old monetary rules. Industrial wars were no longer fought with swords and horses. They were fought with factories, railways, oil, steel, and global logistics. And that required something empires had never needed before: permanent financing. World War I shattered the illusion that gold-backed money could sustain modern power. Countries suspended convertibility. They borrowed beyond precedent. They printed to survive. These measures were sold as temporary emergency tools, exceptional moments. But emergencies have a habit of becoming permanent. Out of this chaos emerged a new idea: one that would quietly reshape global power. Money would no longer be governed like politics. It would be governed like engineering. In 1913, the United States created the Federal Reserve, not as a ministry, not as a political office, but as an independent institution. The language mattered. Stability, expertise, insulation from politics. What it really meant was this: monetary power was being moved one layer away from voters. Europe followed similar paths. Central banks gained autonomy. Interest rates became technical decisions. Public debate gave way to closed-door committees. Then came the second transformation. War financing was no longer episodic. It became structural. World War II demanded unprecedented coordination. Debt was monetized at scale. Currencies were managed, not redeemed. At Bretton Woods in 1944, a new architecture was born. The IMF. The World Bank. A dollar-centered system tied, loosely, to gold. These were not governments. They had no armies, no flags. Yet they would outlive cabinets, presidents, and parliaments. In 1930, even earlier, something quieter had appeared: the Bank for International Settlements. A meeting place for central banks. A hub above politics. A forum without voters. This was the financial equivalent of moving power underground. Instead of ruling through force, the system ruled through access. Access to liquidity. Access to settlement systems. Access to credibility. Certain currencies gained special roles, not by accident, but by design. They were stable, liquid, trusted by institutions that now coordinated globally. The dollar wasn't just American money anymore. It became infrastructure. And infrastructure doesn't need persuasion. It needs compliance. Crucially, this new system did not demand obedience. It rewarded it. Countries that aligned received capital, trade, and stability. Those that didn't face volatility, capital flight, and isolation. No invasion required. Complexity became the shield. The rules were too technical to protest, too boring to headline, too abstract to revolt against. And so monetary power slipped out of politics, quietly, legally, and permanently. Elections still mattered. Governments still changed. But the system that financed them no longer did. What began as a solution to crisis had become something else entirely. A structure designed to survive instability. Even if instability was political, and the final separation was still ahead. Because once money was fully untethered from limits, the system would no longer just outlive governments. It would become untouchable. For most of the time, the financial system feels invisible. Markets open. Banks operate. Money moves. Life goes on. Because real power doesn't need to announce itself. Until something breaks. Crisis is when the architecture becomes visible. Not in speeches. Not in elections. But in the speed of response. When confidence evaporates, governments hesitate. Markets don't. Capital moves in seconds. Currencies weaken overnight. Interest rates spike before parliaments convene. And suddenly, sovereignty has a price. Consider what happens in a modern financial crisis. Liquidity dries up. Credit freezes. Trade slows, then stops. Countries don't ask voters what to do next. They ask markets. Can we roll our debt? Can we defend the currency? Can we access dollars? Because without settlement, nothing functions. In 1997, during the Asian financial crisis, entire economies collapsed without a single bomb falling. Currencies imploded. Capital fled. Governments that had seemed stable weeks earlier were forced to accept external conditions to survive. It wasn't political defeat. It was financial suffocation. A decade later, in 2008, the illusion finally shattered at the center of the system itself. Banks failed. Markets panicked. Trust vanished. Governments debated. Central banks acted. Interest rates were slashed. Liquidity lines were opened. Trillions were created, instantly. No public vote. No referendum. no national debate. Because the decision had already been made, years earlier, when power was embedded into institutions designed to move faster than democracy. And notice what didn't happen. The system didn't collapse. It didn't reset. It didn't fundamentally change. It stabilized itself. Losses were absorbed. Debts were socialized. Assets were protected. And once again, the architecture emerged stronger than before. This is the core reality of modern power. It doesn't rule through commands. It rules through constraints. If a country loses access to reserve liquidity, its trade freezes. If investors lose trust, capital escapes. If settlement access disappears, sovereignty becomes symbolic. Elections still happen, but choices narrow. Governments promise growth. Then consult bond markets. They promise reform. Then watch credit ratings. They promise independence. Then manage exchange rates. This isn't cruelty. It's indifference. The system isn't designed to punish. It's designed to preserve itself. And that makes it more powerful than any ideology. Because it doesn't care who wins an election. It only cares whether obligations are met. During crises, people feel this power personally. Inflation arrives without warning. Savings lose value silently. Wages lag behind prices. No announcement. No villain. Just adjustment. And the most unsettling truth is this. The most important decisions are made before crises begin. Embedded in rules. Encoded in access. Locked into architecture no one votes on. By the time panic reaches the streets, the system is already executing its response. Crisis doesn't expose failure. It exposes design. And once you see that, the next question becomes unavoidable. If power now reveals itself only during collapse, who benefits when collapse becomes manageable? Every system creates an order. Not always by force. Not always by law. But by access. After each crisis, the financial system doesn't reset. It reorganizes. And what emerges is not chaos, but hierarchy. Picture the global economy as a multi-level building. At the top floors, doors open automatically. Liquidity is abundant. Borrowing is cheap. Mistakes are survivable. Lower down, doors open slowly. Access depends on approval. Interest rates rise. Mistakes are punished. At the bottom, the doors are locked. No reserve currency. Limited credibility. Capital enters reluctantly and leaves instantly. This is how modern power sorts winners from losers. Those closest to money creation. Central banks, major financial institutions, reserve currency nations are insulated from shock. They receive support first. They stabilize fastest. They recover strongest. Losses are delayed, then distributed outward. Asset prices rebound. Balance sheets heal. Confidence returns, for some. Further away from the center, the experience is different. Currencies weaken. Imports grow expensive. Inflation arrives quietly. Savings shrink. Wages lag. Public anger rises, without a clear target. Governments in these positions face a narrowing corridor of choice. Spend too much, and markets punish. Cut spending, and voters revolt. Borrow to survive. But borrowing comes with conditions. This is where dependency becomes power. Not because anyone enforces it, but because alternatives are economically fatal. Credit ratings begin to matter more than campaign promises. Bond yields speak louder than speeches. Confidence becomes a form of governance. And over time, something subtle happens. Political authority becomes temporary. Financial authority becomes permanent. Elections rotate leaders. Markets outlast them. Treaties change. Debt contracts remain. Sanctions are no longer enforced by armies. They're enforced by access. Access to payment systems. Access to liquidity. Access to global settlement. A country can be politically independent and financially constrained at the same time. That is the new hierarchy. And here's the quiet truth most never hear. No grand conspiracy is required. The system doesn't need coordination. Only continuity. Institutions defend their role. Markets defend stability. Risk avoids uncertainty. The structure reinforces itself. Each crisis strengthens the belief that intervention is necessary. Each intervention strengthens the architecture. Each reinforcement increases dependence. For the system, this is success. For people, it feels like distance. Decisions feel remote. Outcomes feel inevitable. Responsibility feels diffuse. Power hasn't disappeared. It has moved higher up the building, into places that rarely make headlines. And once power becomes architectural rather than political, the next question is no longer who benefits. It's whether this hierarchy can hold. Today, the architecture of global financial power is larger than at any point in history. Central banks hold balance sheets once considered unimaginable. Global debt has surpassed levels that would have triggered collapse in earlier eras. Markets now react to a single sentence, sometimes a single word, from monetary authorities. Elections still matter. But markets move first. This is not accidental. After decades of crisis management, intervention is no longer debated. It's expected. Liquidity support is assumed. Stability is priced in. Collapse has become unthinkable. And that belief is the system's greatest strength, and its greatest vulnerability. Around the world, quiet adaptations are already underway. Digital payment systems expand settlement speed and control. Alternative trade corridors form to reduce exposure to dominant currencies. Regional financial blocs experiment with local settlement, carefully, cautiously. Not to overthrow the system, but to survive within it. Because opting out is still too costly. What most people misunderstand is this. The system wasn't designed to rule people. It was designed to prevent panic, to stop bank runs, to stabilize trade, to absorb shock. But stability has a price. Distance between decisions and consequences. Protection without accountability. Risk without immediate punishment. The architecture adapts by redistributing stress. Inflation instead of defaults. Currency depreciation instead of collapse. Asset inflation instead of mass failure. Pressure moves, it doesn't disappear. And history is clear on one point. Every global financial order believes it has solved the problem of instability. Every one eventually discovers new fractures. The question is no longer whether change is coming. It's how quietly it will arrive. Whether adaptation remains manageable. Or whether confidence finally breaks. Because systems don't fail when they're weak. They fail when belief in them becomes absolute. This was never a story about villains. It was a story about systems that grew beyond the people who created them. Power didn't disappear. It didn't hide. It simply moved somewhere quieter. Somewhere more permanent. Empires once ruled through force. Today, power flows through architecture. Through rules. Through access. Through systems designed to survive collapse. And history's most important question is no longer, who is in charge? It's this. What happens when the system can no longer save itself? Because history doesn't announce turning points. It whispers. Until suddenly it doesn't. If this revealed something deeper, subscribe. The pattern of history never lie and I'll guide you through them.